Welcome back. You're still tuned into Trading Hour here. The market has picked up a little bit, by the way, while we were talking about this entire mutual fund space. The Nifty Bank around 90 points in the green. For the Nifty, it's absolutely flat right now. But let's also talk about the life insurance space, because while there's no disappointment, there is the disappointment that there's no relief on the budget proposals. The mood is still upbeat. Yash has spoken with all of the top insurers and he's here with the key takeaways. Yash.
Well, Pavitra, of course, this particular move on taking the indexation benefits away from debt mutual fund schemes is disappointing for the mutual fund industry, but it's also a blessing in disguise for life insurance companies. There is some bit of disappointment from life insurance companies on two factors: that none of the amendments were made to the budget proposal. The threshold for taxation on 5 lakh wasn't raised to as it was expected to 7 or 10 lakh rupees. And the second one, no indexation benefits came through for the life insurance industry as was demanded by these companies. But what's the blessing in disguise? Now, this particular move on mutual funds essentially makes life insurance products, long-term savings life insurance products, more attractive than these schemes again. And from the industry feedback, we've been able to pick up 3 important points on how it makes these products more attractive. As far as indexation benefits taken away from debt mutual fund schemes are concerned, that again improves the internal rate of return, or IRR, for life insurance companies. Long-term savings life insurance policies where taxation was announced on a cumulative premium of more than 5 lakh. The internal rate of return is about 6.5 to 7%. The IRR for debt mutual fund schemes is about 100 basis points lower than that. But now, with indexation benefits not being available with both industries, this arbitrage of 100 basis points of incremental IRR still remains with long-term life insurance policies, hence keeping these products more attractive than long-term debt mutual fund schemes. Second part is the disadvantage with respect to reinvestments. Long-term savings life insurance policies are generally about 10 to 15-year long products, where the taxation which the government has announced in the budget has to be paid at the time of maturity, which is at the end of 10-15 years. Here, with debt mutual fund schemes being 3 to 4 year products, in the duration of 10-15 years, in case of reinvestments on funds coming from these debt mutual fund schemes, one would have to pay taxation twice or thrice if there is a case of reinvestments, which is not like something that would happen on the life insurance side. Third and the final one, long-term, no taxation on insurance under 5 lakh. Towards long-term life insurance policy, there won't be any taxation if the premium does not exceed 5 lakh annually. Whereas on the debt mutual fund side, irrespective of the amount which is invested, there will be taxation and there won't be any indexation benefit there.
Okay, got that. Thanks very much, Yash, for explaining the maths to us. And I think this is going to be extremely critical in the days to come as investors figure out which is the product that they will opt for. Well, on that note, let's move forward. We are looking at, of course, insurance stocks. A lot of them are off the lowest levels of the morning. Surabhi is here tracking some of these details. Surabhi?
So we've all spoken about how it impacts the industry. Now let's look at some numbers in detail. For the life insurance space, investors now may prefer life insurance products over debt mutual funds if their annual investment is up to 5 lakhs, as that is currently under the tax-free bracket. For above 5 lakhs of annual investments, policy and debt funds are at near parity. When you look at their IRR, which is the returns over the 10-year period, the non-par guarantee savings linked products, which was under the limelight post the budget announcement, will generate a return of 6.5 to 7%. And debt mutual funds, post this finance bill announcement, will generate a return of 5.5 to 6%. Now here we've considered a marginal tax rate of 30%. Post-budget, analysts estimated that there will be an 8 to 10% loss in APE from April 1, and also the APE for March will grow at a rate of 15 to 40% as opposed to 5 to 10% last March. Now, post the finance bill announcements, analysts estimates that there will be a lower loss of APE in H2 of FY24. They may see a pickup in sales in the ULIP products, and also within that, SBI Life may do better as they have a higher exposure of debt-oriented ULIPs. Now let's look at the valuations of the life insurance players. Pre-budget and current valuations, they have seen a significant corrections, where HDFC Life has seen the most corrections from 3.8 times price by embedded value to 2.2 times on an FY24 basis, followed by Max Financials and ICICI Pru.
Thank you very much, Surabhi. Before that, need to slip into a very short break. We'll come back, discuss markets. Varun Goyal of Nippon India AIF joins us next.